Financial literacy is the ability to understand the use of money as it applies to your personal finances, according to the National Financial Educators Council. It can help you make better decisions and is a key element in improving your behavior and planning when it comes to your personal finances and overall financial wellness. Financial literacy skills. Financial literacy skills include an ability to find, understand, and use resources and information to help you make informed decisions about your personal finances, according to the American Institutes for Research. Having these skills can provide the confidence, knowledge, and ability to make solid financial decisions. Financial literacy skills promote financial self-sufficiency, stability, and well-being. Why is financial literacy important? Financial literacy is important because it empowers you to make informed and responsible financial decisions. It helps you understand concepts like budgeting, saving, investing, and debt management. It allows you to make better decisions through problem solving, critical thinking, and having a grasp of essential facts and concepts related to basic personal finance. Building your financial literacy helps you create a secure future, avoid financial pitfalls, and achieve your financial goals. The 5 principles of financial literacy. There are 5 principles of financial literacy: earning, saving and investing, borrowing and managing your debt, spending and planning, protecting your assets. These principles of financial literacy serve as a roadmap for good money management and are the establishment of a solid financial foundation. Learning about them and putting them into practice can improve your financial situation now and in the future. Earn. Your income is the foundation of your personal finances. It is the basis for your lifestyle and your financial future. Implementing the principle. Learn to live within your means and pay for your lifestyle without excessive debt. Manage your income and workplace benefits. Take advantage of employer matches for your 401k or similar retirement plans. Find ways to put aside portions of your income for the future. Set up automatic retirement plan contributions so you won't be tempted to skip a contribution toward your retirement. Saving and investing. Creating a budget will help you put aside money for savings and investments. This allows you to grow your wealth and can empower you to make major financial plans such as buying a house or paying for retirement. Implementing the principle. Monitor where your money is going each month. Cut out optional expenses for things you can live without and put the money into savings or investments such as an IRA, investment fund, or annuity for retirement. Create separate categories or buckets in which you can set money aside for specific goals, from holiday presents to vacations to home purchase to retirement. Borrowing and debt management. Borrowing wisely will allow you to make major purchases while building your credit. This can help you pay for a home, car, or a college education. But avoid excessive debt that can eat into your ability to save and invest in the future. Implementing the principle. Carefully weigh major loans to determine if you can afford them. Make sure you live within your means. Review and compare interest rates before applying for a loan. Keep debt to a minimum and easily manageable within your budget. Pay your bills on time and make more than the minimum payment. Monitor your credit score. Financial expert Chip Stapleton offers a wise strategy to get and stay out of debt that anyone can practice. Spending and planning. When you get your paycheck, consider following the 50-30-20 budget or the 80-20 strategy. Following the 50-30-20 budget means putting 50% of it toward needs, 30% toward wants, and the remaining 20% toward savings and investments. This is one of several personal finance strategies that can help you keep your spending on track. With the 80-20 budget, you pay yourself first by setting aside 20% for savings, then using the remaining 80% for both fixed and variable expenses. Implementing the principle. Shop for the best value when making purchases. When making a large purchase, consider whether it is a need or a want and consider whether buying it is within your means. Consider paying yourself first by making it a habit to set money for savings aside before anything else to shape and drive your budget. Protecting. You will need to protect your financial assets, savings, investments, and your budget. This can take the form of an emergency fund and insurance. Implementing the principle. Create an emergency fund, enough money to pay for 3 to 6 months of expenses. Determine with your spouse or partner what constitutes an emergency and only dip into the fund for those situations. Purchase insurance to cover risk to yourself and your belongings. Consider homeowners or renters insurance, health insurance, car insurance, disability insurance, and life insurance. How to set financial goals. To set financial goals, start by distinguishing between short-term and long-term objectives. Short-term goals focus on immediate needs or desires. Long-term goals encompass longer-term milestones like retirement or buying a house. Determine how much money you need to achieve each goal. You'll need to consider factors like inflation and time horizons, the amount of time left before your goal. You can break down the goals into smaller milestones and create a timeline for accomplishment. You can use tools like spreadsheets for budgeting apps to track your progress. And you should regularly reassess and adjust your goals as circumstances change. Celebrating milestones along the way will help you stay motivated. How to create a budget. A budget is a plan for spending your money each month. Creating a budget will help make sure you don't run out of money before the month is up. You can also use it to save money to pay for long-term goals. Begin creating your budget by making a list of your monthly expenses. Expenses can include rent and other bills that are the same each month, utilities and other bills that are different each month, car insurance and other bills you may only pay once or twice a year, clothes, credit card bills, entertainment, food, gas and transportation, school supplies, unplanned expenses such as home or car repairs and medical expenses. Now, figure out your income. Write down how much money you make every month. Include all forms of money, like paychecks, tips, side jobs, or child support. Finally, subtract your expenses from your total income. If the number is less than 0, you are spending more than you make. You'll need to look for places to cut back your expenses or find a way to make more money. If you get a number greater than 0, this is money you can budget each month towards savings or some other financial goal. Let's talk about your financial goals. Take our free 3-minute quiz to match with a financial advisor instantly. Recommendations tailored to your goals. Using your budget. You can use your budget to make a plan at the beginning of each month on how you will spend the money you earn. Keep track of your spending by writing down everything you spent each day or keep track using an app. At the end of the month, you can see where your money went. This can help you adjust your spending. You may discover expenses that you can cut back on or eliminate. Use this knowledge to adjust your next month's budget. If you do every month, you'll eventually fine-tune your spending and saving to make it more manageable and efficient. And it can help you start saving more. To create savings, start by setting up a dedicated savings account. Making a separate account will help you separate your savings from your everyday expenses. Next, make regular deposits into this account, whether it's weekly, monthly, or based on your paycheck. Consistency is key. Automating your savings deposits can keep your deposits consistent. Direct deposits from your job mean you won't notice a portion of your income going into savings. Automated deposits can keep you from skipping one. You also won't forget to make a deposit. By following these simple steps, you will build up your savings over time. How to invest money. When you invest your money, it's essential to have a clear financial goal in mind. Most people invest for retirement, but others invest for specific purposes like buying a home or paying for their children's education. Starting with employer-sponsored retirement plans, such as 401(k), can be a great way to begin investing, especially if your employer matches your contributions. By consistently putting money into these plans, you can build significant savings over time. Different investment options, such as stocks, bonds, and mutual funds, come with different benefits and risks. It's essential to know the level of risk you're comfortable with and balance that against your financial goals. This balance varies from person to person, so understanding your risk tolerance is crucial. Finally, the amount you should invest depends on your unique financial situation and goals. It's never too late to start investing, but the earlier you begin, the more time your investment portfolio has to grow. How to protect your assets. Insurance is important to protect your assets because it provides financial security in case of unexpected events, such as accidents, natural disasters, or lawsuits, minimizing the financial impact and helping safeguard your hard-earned assets. Types of insurance for protecting your assets. Life insurance. Disability insurance. Health insurance. Homeowners or renters insurance. Life insurance. The most important reason for purchasing life insurance is to provide financial protection to named beneficiaries in the event of the policyholder's death. You can also develop life insurance strategies to help achieve various financial goals, such as saving for education, retirement, optimizing estate plans and supporting business succession plans. Disability insurance. Disability insurance is important because it protects your income in case you become disabled and can no longer work. It covers common but disabling injuries and illnesses that can prevent you from working for extended periods of time, such as cancer or severe bodily injury. It can also provide an income source while you are unable to work. It is especially beneficial for sole providers or parents who need to support their families. People with recurring injuries or those in physically demanding jobs should also consider disability insurance. Health insurance. Health insurance protects you against financial risks from high medical costs. It covers the most essential medical benefits necessary to keep you healthy. And it helps you pay for treatment of injuries and illnesses. It also covers preventive care, which can detect a serious condition early. This can lead to early and less complicated treatment. Health insurance is often provided by employers in the United States. But you can also purchase health insurance on your own. Homeowners or renters insurance. Homeowners and renters insurance protect your belongings if they are lost, damaged, or destroyed through theft, accident or acts of nature. Both can also protect you financially if someone is injured in your home or apartment. In the case of homeowners insurance, your whole home may be insured against loss or damage. Common financial mistakes. Financial literacy can help you guard against some of the most common financial mistakes people make. These include problems with credit card and student loan debt and predatory lending. Credit card debt. The most common financial mistakes with credit card debt include overspending, making only minimum payments and carrying high interest balances. To avoid the credit card debt trap, stay on budget and only charge what you can pay off each month to avoid interest and build your credit score. It's also wise to set up automated payments so you don't miss any, adding unnecessary interest and penalties to your bill. Making more than minimum payments each month can help to pay off your debt faster. Student loan debt. With student loan debt, common mistakes include borrowing more than necessary and not understanding repayment options. Tips for avoiding student loan debt. Apply for financial aid, grants, and scholarships to reduce your reliance on loans. Consider federal, state or nonprofit loans over private loans. Only borrow what you need. Pay interest while still in school to reduce the amount of debt. Refinance your loans if interest rates go down. Even before applying to college, student financial literacy should be a critical part of a young person's education. Predatory lending. Predatory lending mistakes involve falling for high-interest loans and deceptive lending practices. To avoid becoming a victim, do your research and compare loans from several lenders. It's best to avoid high-interest loans, particularly those at interest rates that grow faster than you can repay them. Don't sign any loan agreements without understanding everything required for repayment. Be cautious of phone calls, door-to-door, or mail solicitation offering loans. These are often a sign of predatory lending. Thank you for watching this video.